Blackstone circling a stake in the Global Cricket League just screams we have way too much dry powder and we are incredibly bored.
Or it means live sports actually has pricing power. Are we really leading with cricket when Apollo just dropped $3.7 billion on a Japanese glassmaker?
Because glass is boring, Maya.
Glass is margin. Nippon Sheet Glass is exactly the legacy industrial asset private equity drools over right now.
Fine, we will cover Apollo's giant window shopping spree. But I am absolutely making you talk about the Estee Lauder gossip first. The rundown.
1.67 billion Canadian for Guardian Capital. Desjardins isn't messing around.
It's a pure scale play. Combine those two, and suddenly you're looking at 280 billion in assets under management. That puts them in a totally different weight class.
Sure, but integrating asset managers is notoriously messy. You're buying people, and portfolio managers walk when the bonus structure changes.
Spoken like a true cynic.
I prefer realist. Speaking of realists, did you read the Equitech report on AI deal-making?
The one claiming buyers are getting cautious? Please. Every sell-side deck I see still has AI-powered slapped on page 3.
In the deck, yes, but in due diligence, deal-makers are actually hitting the brakes. They're asking to see the code. They want to know if it's proprietary machine learning or just an API wrapper around ChatGPT.
I think that's just lawyers justifying their hourly rates. The broader market enthusiasm is completely unbridled. If you have AI in the name, you get a premium.
I completely disagree. The data shows diligence timelines on tech assets are extending by weeks. Buyers are terrified of buying vaporware at a 20 times multiple.
I'll believe the caution when I see the multiples actually drop. Speaking of multiples, how do you value a cricket team?
Wait, really? Who's buying a cricket team?
Blackstone. The rumor mill says they're evaluating a surprise stake in the Global Cricket League.
Stop it. Blackstone? I just can't picture John Gray in cricket whites.
I'd pay good money to see that. Private equity loves live sports right now. Sticky revenue, massive broadcast rights.
I suppose. Meanwhile, Gilead just quietly picked up Ouro Medicines, privately held clinical stage T-cell engager.
Bolstering the inflammation portfolio, classic pharma bolt-on, just like Arlington Capital expanding its defense portfolio by buying Eptec Defense in Australia.
Right, naval defense vessels. It's a smart middle market play. And Stepstone data just showed early-stage PE funds doing middle market deals are actually beating the legacy megafunds on IRR right now.
Which is fascinating. But if you want to talk about the mega funds making massive plays, we need to talk about Apollo.
We absolutely do.
Because dropping $3.7 billion on a Japanese glassmaker is exactly the kind of old-school industrial buyout I live for. The big one. So Apollo is literally buying into Windows.
$3.7 billion for Nippon Sheet Glass.
590 billion yen if we're being precise.
Which is fascinating because I spent all morning trying to figure out why Apollo wants a Japanese legacy flat glass maker.
Cash flow. It's the most classic private equity playbook ever written. You find a boring, capital-intensive industrial asset, you optimize the debt structure, and you just collect the toll. It's beautiful.
Beautiful is a strong word for architectural glass. Look at the capital expenditures required here. You have to rebuild these glass furnaces every 10 to 15 years. It's a massive cash sink.
But the barriers to entry are huge. Nobody is starting a competitive flat glass company in their Silicon Valley garage.
Sure, but where's the growth? We're looking at a market that basically tracks GDP.
Apollo doesn't need hypergrowth here. They need stability. They lever it up. They run it lean, and they generate a totally predictable return.
I completely disagree on the predictability. The automotive segment of Nippon is heavily tied to global supply chains, which is still a mess. And frankly, this feels like a defensive move.
Defensive how?
Look at the recent Stepstone data. Debut and early-stage private equity funds focused on middle market deals are absolutely crushing legacy megafunds right now on internal rates of return. Apollo is sitting on so much dry powder, they have to deploy it in these massive low-growth industrial chunks just to move the needle.
Okay, wow, so you think Apollo is settling?
I think a $3.7 billion buyout of a legacy industrial is what happens when you're too big to play in the high-yield sandbox. They're basically buying a bond proxy with operational risk.
A bond proxy made of glass. I should have been a poet. Honestly, though, you're undervaluing the turnaround potential. Apollo is notoriously good at finding the fat in these legacy operations.
I'm sure the Nippon executives are thrilled to hear you call them fat.
You know what I mean? Operational efficiencies?
I do. But I actually read the press release footnotes. The integration costs are going to be significant. They're taking on a very complex capital structure in that enterprise value.
True, but if anyone can untangle Japanese corporate debt, it's Apollo. They aren't buying this for a quick flip. This is a 10-year hold.
We'll see. I'm putting this in the wait and see file. I need to see their first post-buyout restructuring plan before I buy your narrative.
Fair enough. But if you want a narrative that's entirely built on glamour and absolute chaos instead of factory furnaces, we need to look at the rumor mill today.
Oh, you mean the Estee Lauder whispers?
Exactly. Spain, Puig, and a very aggressive beauty conglomerate play. Voices. I am reading this new Equitech report, and honestly, I feel like they wrote it just for you.
Oh, did someone finally put in writing that AI multiples are completely detached from reality?
Exactly that. They are saying deal makers are getting incredibly cautious during due diligence on AI assets. It is a sharp contrast because the public market is still throwing money at anything with a .ai domain.
I knew it. You cannot diligence a black box. The broader market hype is unbridled, but when a buyer actually looks under the hood and asks for the revenue model, the math just breaks. Sanity is returning to the chat.
I think you are being too harsh on the tech space, but fine. The real surprise is what StepStone is seeing in the middle market. Their new data shows debut and early stage private equity funds are outperforming legacy funds.
Wait, really? First-time funds are actually beating the mega cap guys.
Delivering higher internal rates of return across the board.
See, I completely buy that. Legacy funds are bloated. They are sitting on massive dry powder, overpaying for targets and diluting their returns. A scrappy first-time fund can actually find reasonably priced deals.
Spoken like a true cynic. But you want to talk about reasonable prices? Look at Southeast Asia. Market analysts are flagging that financial service valuations are actually dipping over there.
Because buyers are pivoting to minority investments. I saw that note.
Yeah, they are dipping a toe in instead of buying the whole pool, which goes completely against the global surge in mega deals we are seeing everywhere else.
It is smart risk mitigation.
Look, as a recovering banker, I hate a minority stake. It is a fraction of the advisory fees for twice the headache. You want control.
A banker admitting a smaller deal means less money for them. Tragic. Play the world's smallest violin.
Hey, I have to defend my people. Speaking of people trying to buy total control, the rumor mill is spinning out of control in the beauty sector today.
Oh, I have seen the whispers out of Spain. Spill the tea.
Okay, I am completely obsessed with this Estee Lauder rumor. Buying Puig, that is exactly how you build a modern beauty empire.
Or how you build a completely bloated integration nightmare.
Oh, come on. Puig has Charlotte Tilbury. They have Carolina Herrera. Estee Lauder desperately needs that heat. They are playing Monopoly and buying Park Place.
They are playing Jenga and pulling from the bottom. Look at the StepStone data that just dropped this morning. The highest IRRs right now are coming from debut and early stage private equity funds doing middle market deals. They are outperforming legacy funds precisely because they are not giant conglomerates trying to swallow each other whole.
You just hate fun deals.
I hate fabricated synergies. Speaking of questionable synergies, did you see the grab leak? $600 million for Food Panda's Taiwan operations.
I saw it. But honestly, the rumor that actually made me spit out my coffee today was Blackstone.
Wait, the cricket thing?
Yes, Blackstone is reportedly evaluating a stake in the Global Cricket League. Just picture a room full of private equity guys in fleece vests trying to explain a wicket to the investment committee. I would pay actual money for that audio.
I mean, sports franchise valuations are completely detached from reality right now, so it fits. They are treating sports leagues the way the broader market treats AI startups.
Which is hilarious considering that Equitech report showed dealmakers are finally getting terrified during AI due diligence. Everyone loves a generative AI pitch deck until they actually have to look at the code.
Exactly. It is all fun and games until the tech audit comes back. But if you want to talk about old school, boring, beautiful returns, we need to look at what Warren Buffett is doing in Japan tomorrow.
287.4 billion yen headed straight for Tokyo Marine. Tomorrow's radar.
I'm already refreshing the SEC portal for tomorrow. We finally get the regulatory filings on Zions Bancorp acquiring that Fannie and Freddie business.
You're literally the only person setting an alarm for a regional bank's regulatory paperwork.
Somebody has to read the footnotes, Nate.
Oh, come on. The real heavyweight move tomorrow is in Japan. We're waiting to see if Berkshire actually formalizes that 287.4 billion yen investment in Tokyo Marine.
Wait, really? 287.4? Look at you citing exact decimal points.
I read your prep sheet sometimes. But honestly, skip the insurance plays. Keep your eye on Blackstone. They're reportedly evaluating a surprise stake in the Global Cricket League.
Cricket. You've got to be kidding me.
Private equity loves sports media rights. It's the ultimate sticky revenue.
Buying into cricket is just a Wall Street midlife crisis disguised as alternative asset allocation. We'll see if the math actually plays out tomorrow.